Thank you for joining today's webinar. We like to have many of these every month, a couple times a month, just with some different topics and presenters. Today's presentation is by best-selling author Jea Yu, who has over 15 years of active trading experience in the U.S. equities and option markets. He was voted Forbes Best of the Web for 4 consecutive years. He works for Alpha 7 Trading Academy, and you can learn more about their services by going to alpha7trading.com. He also is a co-founder of undergroundtrader.com, the premier virtual trading desk and trader education site that has served over 10,000 traders, fund managers, and investors worldwide since 1998. He has published bestsellers, and his last book to be published in 2013 was The Way of the Trade, Tactical Applications of Underground Trading Methods for Traders and Investors. So definitely look out for that. He has a lot of experience, 15 years market experience, and he has presented to sold-out rooms in Vegas and all over the street. So we're excited to have him back. He's going to pick up where he left off on his last rifle charts presentation. So we're going to get going in just a minute. I just want to give our standard risk disclosures for Lightspeed and for the markets in general. Please keep in mind this presentation is for informational purposes only. Nothing presented today should be construed as investment advice or a recommendation to buy, sell, or hold any specific securities. Since we don't know everyone's investment objectives or risk tolerance, we are not endorsing any specific trading strategies. We encourage you to ask questions as we go throughout the presentation. You could do that as you go by typing them into the web box, chat box, and we'll try to answer those as we go or at the end of the presentation. This presentation, along with many of our other ones, will be uploaded to our online webinar library. You'll be able to see this and past webinars at lightspeed.com/webinar. If you have any specific questions about opening an account or anything we talked about here, feel free to email sales@lightspeed.com or visiting www.lightspeed.com. Okay, now I'm going to hand over the presentation to Jay. He's going to put on his screenshots here, and we'll get going. So just give us one moment while I switch the presentation to Jay. Thank you.
Thanks, Rob. Okay, thanks everyone for showing up. We're going to get the presentation started. Okay. Okay, can you guys see my screen?
Yes.
Okay. All right. Okay, let's go ahead and get started here. All right, so today we're going to talk about spotting entries and exits using rifle charts on the Lightspeed platform. And this webinar is brought to you by Lightspeed and Alpha 7 Trading Academy. All right, so Rob pretty much went over a lot of stuff about me. Been around for over 16 years. Bear markets, bull markets, decimalization, fractions, Instinet, dark pools, you name it. I've been there. So everything I talk about in this webinar is all based on first-hand experience, and basically I'm just trying to show you stuff that works right now in this environment. You know, one of the problems with a lot of teaching methods and systems is that, you know, the market always changes, the paradigm always shifts, okay, at least on the surface, and so as things change and shift, methods can get stale, okay, unless you have methods that are not so much reliant on static numbers and static ranges, but you have components that are dynamic, and they move with the prices, and they stay consistent for the most part through all market environments. And I'm going to talk to you about some of these environments in a little bit. So what's in this webinar? We're going to go over the components of precision scalp trading. Okay, we call it scalping, and that's basically getting in and getting out. If you believe that risk is based on two things, your position size and the duration of your holding period, okay, those two are the two components of risk. It's your size and how long you're holding. And with scalping, the main thing about scalping is that your holding period is the lowest. Okay, it's the smallest amount of holding time. So you want to get the most amount of a move within the shortest period of time, and if you make sure that your probability is high, it's a high probability setup, then what you do is you take advantage of adding more size, playing with a little more leverage, more size, smaller period of time. Now, as far as the price moves that you're looking for in the stock, you're not looking to hold the stock for hours at a time. Okay, you're looking for literally minutes to be able to capture the biggest move you can get, shortest period of time, with the most size that you're comfortable with. And that's what scalping is. And we're going to go over entry and exit methods. And then I'm going to show you 2 trade sequences putting the scalping methods to work. Okay, and these are all captured on a video and narrated, and go over that. And then at the end of the seminar, a little special offer for the attendees. Okay, so you always hear about the cliches, plan your trade, trade your plan. But what exactly does that mean? And so that boils down to what type of strategy are you playing? Okay, now with Alpha 7 Trading Academy, I've worked with them to put my whole methodology and system into a whole complete training course. And I'm only going to speak about my system because, hey, that's all I know. Okay, so when it comes to the type of trades, when it comes to scalping, okay, once again, I explained what scalping is, but there are the other components outside of just the method and strategy, which I'll go over in a little bit, are going to make just as much of a material impact, okay, as your system. So first and foremost, everyone should have what I call bucket stocks. And actually, one of my members actually coined it bucket stocks. One of my members, Clark G. I used to call them basket stocks, but bucket stocks are good. And bucket stocks are stocks that you can go to. They're go-to stocks that you should be able to play on a daily basis. If you're not finding momentum movers or stocks that are gapping up or gapping down, the bucket stocks, they're there for you. If you're not, if the markets, if the SPY, for example, in the future, if they're volatile and they're whipsawing in a big range, the bucket stocks are where you want to go. Now, when you talk about your bucket stocks, they got to be stocks that are very heavily traded and that actually do move. Okay, I'm so glad that Apple split 7-1 because that brings in more players, more participants. Okay, and at that point it became a great bucket stock because there's so much liquidity in Apple. Apple has the most liquidity. If you want to work on a bucket stock, it does tend to chop a lot sometimes. It goes through periods of very thick chop, and then when it breaks fast. Okay, Facebook is one that tends to oscillate very nicely, especially in the first 10 minutes of Facebook. From 9:30 on, you can get some amazing whipsaw moves, 30 to 60, 70-cent scalps. Twitter can be kind of temperamental, okay, and it's very funny. Twitter and Facebook, they have this weird relationship where they may move together, and oftentimes Facebook will move first, and then Twitter will follow. So if you miss Facebook, you can jump on Twitter. Then there are times where they will just actually be inverted with each other, okay? So you may see Facebook squeeze higher while Twitter moves lower. Now, the last 2 days, Twitter has been self-fading. If any of you guys follow Twitter, 51.50 and 51.30, 2 areas where large sellers started coming in around noon and 2 o'clock every day. Last 2 days, and just been taking it down, even as Facebook continues to stay up. And Yahoo, in the high 30s, low 40s, that's a good bucket stock too. Now, it doesn't move as much as Facebook or Twitter. It's a lot thicker, so you can use more size on that and look for 7 to 15-cent scalps. But the nice thing about Yahoo is the obvious support levels or the obvious resistance levels, when they overshoot, Okay, it's so obvious that a lot of people just keep stops 1 or 2 pennies below those levels, and so when they break, when the stops trigger, what happens? Triggers market orders, and so you get some nice gift panic collapses when Yahoo tanks. So I love that too. Going back to the methods, in my last 2 webinars on Lightspeed, I talked about the rifle charts. And with the rifle charts, which are composed of the stochastics and moving averages and your Bollinger Bands on multiple time frames, okay, when you use them correctly, you can spot setups. You can spot patterns like pups, mini pups, perfect storms, reversions. The Fibonacci levels are very, very strong. They're very good when you use them with the rifle charts. So that the rifle charts contain a whole methodology right there, the strategies and the methodology. Now, I'm not going to go over all the strategies or anything like that. That's just to let you know that's what I use. All right? And then on the rifle charts, when we utilize multiple time frames, like a 15, a 5, and a 1, it gives us a bigger panoramic view of the playing field, okay, from the larger trend all the way down to the precision 1-minute chart, and it gives you a full perspective, okay, of the playing field. And oftentimes your wider time frames are going to foreshadow the move that's going to happen on the lower time frames. So with the rifle charts, it is our complete tool here. Okay, it's just a matter of how you use them. Once again, scalping. A lot of people like to link day trading to scalping, and scalping is something that a lot of people consider it's too risky. It's too fast, it's too risky, blah blah blah. But let me tell you, scalping by nature is actually the most risk-averse strategy. It's the most risk-averse strategy. People who think that swing trading is less risky, okay, or investing is less risky. All right, with that, I think that just has to do with what people deem psychologically as a psychological definition of risk. In all reality, scalping, once again, when you take the formula of what is risk is your exposure, okay, and your holding period. Because the longer you hold, the more your position or your stock, it can be influenced by headline risk, okay, whatever the futures are doing. On any given day, there's a 70% correlation between most stocks, tradable stocks, okay, and the SPY in the S&P 500. So if you think that being in a stock to swing it is less risky, well, once again, that goes back down to the 2 formulas again, the holding period and the size. Now, of course, if you're swinging a smaller size, okay, now you're understanding the concept of risk, okay, and you're offsetting that. So perhaps the size may be scaring people, okay, but the reality here is that scalping, along with scaling, okay, is most risk-averse type of trading there is, as long as you're able to react and you have a system. And that takes time. That takes it takes repetition, and it takes precision that you build up your skill sets to do. You have to know ahead of time, okay? You have to know ahead of time where you're going to be taking your profits. And I'm not talking about having a target, okay, a set static target. All right, that may work in swing trading or investing, but with scalping, as far as a target is concerned, if you're long a stock, your next resistance is going to be your target, whether it hits it or not. Okay? So there's a lot of discretionary portions when it comes to scalping. I think that may throw some people off. But like I said, this is the best way. This is the best way to make money in the stock market. to scalp. Now, the other thing that people tend to get wrong is they get turned off from scalping because they may see all the fast price action movement and the market's whipsawing in the first 30 minutes of the market open, and then when it finally slows down, then they decide they're going to scalp around 1 o'clock, 2:30, 2 o'clock in the afternoon. Okay? And that's a complete opposite way to go. With scalping, you need participants. You need volume. You need momentum. And that's going to give you follow-through. And that's why a scalper can make more money in that first oftentimes than what a swing trader may have to wait 2 days for. All right? So it's all about knowing when to scalp. And I'm talking time-wise during the day, when to scalp and when scalping will just end up chopping you around. So that's what scalping is. All right? It takes an intense effort, okay? And you have to work your way up in the size category. You can't just jump right in. Right? But when you get fluent in scalping with precision, your day, and I'll be honest with you, your trading day can be over in the first 90 minutes. Okay? Now, scaling in and out of positions, and here's one thing that really kind of is something that throws people off. Okay, the notion of throwing bad money after, or good money after bad, or averaging down. Okay, people have this notion that, hey, if you average down a losing position, you're just throwing money away. Okay, there's a lot of these cliches in trading that are just very general. All right, and it applies, I guess, to the general masses because generally people can't make money trading. So if you're someone who wants to believe in that and just the surface of the iceberg that pops out of the water and that's all you believe, okay, then it's time to really pay attention here because the generalities don't work. It's all about being specific and scaling in and scaling out of positions. When you're scaling into a position, okay, it's like molding a position. It's like Play-Doh, okay? So rather than just a one-shot entry, you're able to actually get that average price down if you're going long, okay, or the average price up if you're going short. And scaling is an amazing tool. However, you also have to know where the boundaries are. Okay, you also have to know where the bumpers are, what I call them. Okay, and you have to know what the wider trend is, or if there is some premise that tells you that, hey, this thing is at an exhaustion point. You got triple resistance areas in this area. Okay, so you scale into that in increments. All right, as long as you maintain your cool and you're able to react properly, scaling is one of the best weapons for a seasoned trader. Okay, scaling scares people. They want to believe that, hey, I just want a one-shot entry and a one-shot exit. Well, once again, it all depends on your strategy. Okay, are you looking to build a larger position, I don't know, to swing? Okay, or are you trying to take advantage of a reversion that's overextended itself? It's too high to go long, and this thing's overextended itself, and you want to scale in for the reversion back down. But like I said, scaling is awesome. And scaling in, okay, and then scaling out. And when you scale out, you always want to scale out your largest piece first, okay, and then go from there. There's some days where scaling out works great. All right, stock continues to move higher, and you scale each piece out at a higher price. It's great. There's some days where scaling kind of sucks. Your first exit was the best exit, and then after that, you pretty much just scaled out all the way back to even on the rest of the shares. Right? So that's just something you have to feel out. Now, there's a difference between scaling, okay, and then finally at one point you got to just take the stop. And the reason why people generally think that adding to a losing position is bad, okay, is because people don't take the stops. They continue to scale. See, they don't understand the difference when it comes to scaling. There are two types of scaling, all right, and I'm not just talking about entries and exits, okay, but scaling as a strategy. A defensive sprawl scale, okay, that is exactly adding to a losing position. It's adding to a losing position. However, where you add, okay, because where you add is what makes the difference. If you're long, you're adding because, first of all, let's say your premises have dried up, all right, and there's a panic drop. Now, when that panic drop happens, okay, perhaps that could have been you stopping out, but it sells off so fast that it's actually overdone, and you scale in at the bottom. Okay, you scale in at the bottom, scale, and then when it makes the reversion spike back up, you sell into that and you take a smaller loss. Okay, because the rationale behind something like that is if it's, say, a consolidation and you're long, and instead of breaking out, it breaks down first and it rug pulls. Okay? Well, anytime a trend is formed, all trends, all breakouts and breakdowns, they look the same in the sense that they will always wiggle one way and the other. And it's when that wiggle actually wiggles harder, and then when it reverts back lower on a downtrend or higher on an uptrend. So when you're scaling, doing a defensive sprawl, you understand that, hey, this trade is wrong, but the reaction, the overreaction, they took out so many stops that it'd be foolish for me to stop out now and perpetuate that panic. Let me step in, scoop up some shares, average it out, and then sell that into the reversion, into the 5-period moving average before it resumes and then goes from a breakdown into a downtrend. Okay? And that's something you have to be very precise about. This stuff's not easy. I'm telling you, it's not easy. You're gonna have to put effort into it. You're gonna get out of the market what you put into it. Okay, but I'd rather show you where you need to pipe your efforts into, as opposed to you guys just thinking that the more you stare at the screen, you're gonna get it one day. It doesn't work like that. So like I said, with stops, okay, when it comes to scaling, there are times where you're just going to have to throw the towel in. Okay, you're just going to have to take the stops. And it may be a price stop, okay, or it may be an indicator-based stop. But you always got to be able to take those stops. Now, if they're going to nail you, if the premise was very strong, like say a perfect storm, okay, and it starts to reverse, and you take a stop, always understand something. There's a reason why you take a stop. It's either your management, your trade management, and risk management, okay, is off. There's something off about it. Maybe it's too loose today, or too wide, or the pattern itself is changing or eroding. All right, and I personally like stops that it's a matter of the pattern, okay? Because in that sense, the faster you take your stop, the quicker you can jump to the other side, okay? And anybody who's in my rooms, you know, they know that if I take a stop, oftentimes my reentry is going to be twice the size, all right? It's going to be twice the size. Either I was too tight in taking the stop, or the pattern did change, and I know that a lot of other participants are probably trapped in it and not ready to take a stop yet. So we jump in on the other side. To me, stops tell me there's something going on here. Okay, there's something going on either with me or with the stock itself. So it's literally paying, number one, to buy some time and for the true inside information, because who better knows how weak a stock is than someone who is long, right? Who better knows how strong a stock is than someone who's short? Okay, so you have to be able to use that to your advantage. A stop is not the end all. It's simply a pause. Now, when it comes to stops, actually taking the stops, there's two types of stops. There's a precautionary stop, all right? And that's oftentimes going to, maybe it's a small profit or small loss or an even stop. And the reason you take that precautionary stop is because of an indicator failure. Make sure you're not taking a precautionary stop because you're just nervous. That just means you're taking too many shares. Listen to yourself, okay? If you're nervous if the stock pulls back 6 cents, all right, on a Facebook, 10 cents on a Facebook, and you take a quick stop, and then it keeps popping back up, you're taking too many shares, okay? You got to make sure that you understand the type of stop you're taking. Either, once again, it's a precautionary stop, which means, hey, this looked like a breakdown. It snapped back. It's chopping. It may still break down, but the SPY's about ready to break out to the upside. Let me take a stop. Precautionary stop, okay? Or an exposure stop, which is either going to be indicator or price-based. So you take Facebook long, hoping that the 1 minute mini pop plays out, but the 5's got a mini inverse, the 15's got a mini inverse, 1 minute spikes a little, stalls, and is ready to cross over back down. You got to get out of there. That's an indicator stop, okay? Let's say there's a double 5-period moving average support. As the 1 minute's going to come down. You got to get out of there. Because if the price hits, that's going to hit stops, and then you get the market orders to sell. So you're going to be at the back of the line. Okay? Indicator stop. All right, so like I said, when you play matters almost as much as how you play. Okay? Wet versus dry climates. Wet climates are going to be from 9:30 to 9:30 to about 10:15 every day. Okay? Very few exceptions. And during that time, you get robust action. Obviously, as the day wears on, the climate gets drier and drier. Okay? That first 30 minutes is usually going to be where you get the most action. All right, but I would say the first 5 minutes is really for the seasoned traders, very seasoned traders. But it's big reward, big risk, big reward. Okay, like I said, this is a period where Facebook can move. You can catch a 30 to 70 cent scalp on Facebook. It just loves to whipsaw, boom. Fake one way and then rip the other almost every morning. Okay, after that first 5 minutes, you get your first 5 minute candle close. That starts to give a little more clue. Okay, and then the silhouette of the pattern starts to slowly get clearer and clearer and clearer. But as things get clearer, you got to understand everybody else is watching too. And when something becomes too transparent, it's too late. So the name of the game is to find that transparency before it becomes too transparent. Wet climates, robust, volume, momentum, follow through. You can be wrong in a wet climate. Okay? It is always the best time to take your stops because there's enough participants and liquidity and momentum so that if you take an early stop, you can jump on that trade the other way. If you take a preemptive stop and the premises are right, you can jump right back in. Okay? Wet climates allow you to do that. Dry climates, oh man, as the volume thins out and participants thin out, okay, dry climates are rigid, less participants, which means that if you have a loss and you're trying to make that loss back by jumping on the other side, guess what? It is so easy to get chopped around out there, okay? The liquidity thins out. You try to buy 5,000 shares of something, what happens? The asks, they scatter. They scatter. After you get filled chasing, what happens? The asks pile up, and the bids scatter, okay? These are the algos. These are the high-frequency trading programs. And guess what? They are the apex predators. You've just stepped into the territory of the apex predators. When you have more participants, okay, you don't become so much of a target. And that's why dry climates should be avoided. by newbie traders, by most traders. In fact, they are avoided. Why do you think the volume's so low? Volume's low for a reason. Most participants avoid it. And as I said earlier, when it comes to targets, it's very arrogant to say, well, I want this price on my long. Okay? Well, who are you? Who are you to determine that Facebook's going to go to 79? Okay? You're not anyone to determine that. What you're supposed to do, a target, and when we talk about risk and probability, okay, and I talked about this in the last webinar, okay, probability is composed of two things. Number one, obviously the pattern, okay, the type of pattern, and your target. And when we talk about target, we're talking about how much are you willing to accept? How much are you willing to accept to take off the table? All right? The smaller that is, the higher your probability. Simple as that. It's a lot easier for a stock to move 12 cents than it is to move 50 cents, isn't it? So when your targets are smaller, okay, you have higher probability. So the way, as a general rule, the way I like to determine targets is using my bumpers. All right. So if if the premise is a mini pup, a 5-minute mini pup, then we know that the 5-period moving average is going to be the support. We know it's a mini pup and a support because they tried to flush it through the 5, and they failed, and the stochastic spoiled up. What's my next bumper? Okay, if my next bumper is the upper Bollinger Band on the 5-minute chart, okay, or the upper Bollinger Band on a 1-minute chart, okay, or a stinky 250s area, whatever, all right, we measure that. And we say, okay, so there's, there's 30 cents to the next upside bumper. All right? And from there, you just divide it in 3, 10 cents. Okay? So that means your nominal scalp is going to be 10 cents on this trade. If you're good, you'll capture 15 to 20 cents. All right? And basically, that's how I like to come up with targets. And it's going to also depend on how the SPY is trading, too. Now, the nice thing is most of these bucket stocks, they correlate and move with the SPY. Okay? But there are times they diverge. Once again, Twitter diverged. Okay? Twitter diverged from Facebook. And then you had the SPY come down. So those are targets. All right, so now what I want to do is I want to go over 2 trading sequences, demonstrating 2 trade sequences on October 6th. And this is within the first 45 minutes of the market open, guys. All right, first 45 minutes of the market open, Hewlett-Packard and Petrobras. So let's go here. And what I'm going to do is, since I already did the narration, I'm just going to play it here and turn up the volume. So let me know if you guys can hear everything okay. All right, we have Hewlett-Packard. It's gapped up this morning on news that they're going to split the company, same as eBay did, and eBay was just a gap and crap. What you'll notice is that on the 5-minute chart, it rejected back down under 37, which is the 5-minute 5-period moving average, which then sets up a 5-minute mini inverse pup. We went ahead and took 4,000 short, averaged at 36.82. You'll notice that the 1 minute starting to cross back down, the SPY 1 minute peaked out, so now it's coming down. We've already got buy cover orders in at 36.63 and 500 share increments, and notice that the shares is set at 500, so it allows me to scale in and scale out in 500 share increments. You always have to think ahead, be prudent. Notice the 5-minute lower Bollinger Band sit at the 1 minute lower Bollinger Band sit at 36.65. That's why we place those sell orders or the buy cover orders right around that 1 minute lower Bollinger Band. Now notice that 36.66 is ticking, 36.67, 36.69. The 1 minute stochastics on Hewlett-Packard are under the 20 band, so you always got to kind of be careful and be prudent. Okay, be prudent, because Hewlett-Packard, when on the open, there's just chock full of algos. So what we did was we went ahead and covered 1,500 shares at 3670 because of 1 minute so low band. Remember, we're short 4,000 shares. We covered 1,500 out, 3670. We still have the 1,500 shares limits at 3663, which just got hit. So now we're filled on another 1,500 shares at 3663, and now we're down to just 1,000 shares. Notice that the 1 minute stochastics has crossed down. It's still down around the 1474 area on the stochastic. Now, look at that, it's on the 3 band. Okay, we have a limit in at 3556 to cover 500 because the 1 minute lower Bollinger Bands are sitting at 3654. Okay. Oh, wow, messed that up. See, notice how the price, it should have been 36.56, not 35.56. I was wondering why it didn't fill. So, Hewlett Packard's probably not going to drop another full point in the next minute. What we do have to keep an eye on, though, is that the 1 minute stochastics is a very low band. Under the 5 band, that's extremely low. So what we're going to do is we are going to go ahead and look to, first of all, we're going to cancel our orders. We're going to go ahead and fill 500 shares at 36.58, leaving us only 500 shares left. All right. Notice that the 5 minute stochastics, it's still a mini inverse pump, but you've got to keep in mind, even if the lower Bollinger Bands are showing under 36, the reality is that the 1 minute lower Bollinger Bands are very low band. And so when they bounced up through the 20 band, they can coil. And how far can they coil? Just look at the rifle charts. So the 5 minute 5 period moving average, that's trading around 36.94. Okay, so I don't want to risk a bounce to 36.94. All right, and because of that, obviously, that's why we went ahead and scaled down into the momentum. This is what traders have a problem with. They get in, they're in the money, they cheer, and then they start to widen their expectations of where the stock should go. If you know Hewlett Packard, this is a stock that just loves to slingshot against shorts. All right, and look at that. Look at Hewlett Packard right there. Slingshot right back up 36.75, 36.72. All right, so the thing is, we only have 500 shares left. Okay, we were prudent enough to think ahead, and on the panic leans, that's when you want to cover into. That's going to be your best liquidity. Not to mention the fact that this is right off the open, so this is a wet climate. Okay, when you have a wet climate, then you get robust, vibrant moves like you're seeing right now on Hewlett Packard. Now, take a look at Hewlett Packard at 2 o'clock in the afternoon, okay, and it's like pulling teeth just to get a 5-cent move. So we went ahead and locked out the last 500 shares, 36.66, and we're closed out. So the trade was Hewlett Packard Gapper. We went ahead and took it short. Number one, because 5 minute peaked out coming into the open, it had a 5 minute mini inverse pump. And the other thing is, well, yeah, the news is splitting a company into two. Let me put it this way. If you have one big fat turd and you split it into 2 turds, are you not still stuck with turds? Okay. That's the same with eBay. Gapped up, sold off. Hewlett Packard, identical template. Gapped up, sold off. Okay, so with that understanding, and it's not just me putting the dots together, everybody's putting the dots together. Because eBay's split notification was, I think that was like, the news was a week or 2 weeks ago. Okay? So that's one thing. That's, you may be able to go off of that, but realistically, you also want to have those rifle charts. And those rifle charts show that off the open, the bulls try to spike that thing up to through 37.15. All right. Now, as you notice, if you noticed earlier in the video, I tried to nail that thing short at 37.08. All right, but it had dropped so quickly. Once it dropped under the 5 minute 5 period moving average, okay, that's when the bulls just wilt and the bears come in. So when it broke under 37, I was in a hurry to go ahead and capture this thing short. 5 minute has a beautiful mini inverse pump. We know where the resistance is on that 5 period moving average, and the 1 minute is the trigger. Now you'll notice that we got into the shares short, 4,000 shares short, even before the 1 minute crossed out. Because if you wait in periods of a wet climate and a lot of volatility, if you wait too long for the trigger to happen, you're going to be chasing it. The algorithms and the high-frequency trading program, they know this. That's why they will jump in and fade into these moves. So is there another clue? Well, like I said, the 5 minute has a mini inverse pump. How did it get there? It rejected back down under the 5 period moving average. That right there is your first clue. Number one. Number two, the SPY was peaking out. Number three, well, the 1 minute crossed back down. Okay, but in a situation like this, we didn't wait for the trigger to happen. In fact, when the trigger happened, that's when we got that beautiful liquidity with people panicking out. And we used that panic to cover into. Everybody and their grandmother could have covered into that liquidity, and out was 657 in profits in under 6 minutes using the rifle charts. All right, so now we're looking at PBR, Petrobras, and we see that the 5 minute has a possible mini inverse pup. We're shorting 10,000 shares right into the 5 minute mini inverse pup, and the 1 minute stochastics made a cross down. So that's the trigger. We're in 10,000 shares, average at 1593. And once again, we have the 1 minute cross down. So when we take larger sizes, we want to aim for smaller targets. That narrows our risk and increases our probability. So we went ahead and placed some limit orders to start covering 2,000 shares apiece at 1581, 1579, 76, 77. And that coincides with the 1 minute lower Bollinger Bands and also the 5 minute lower Bollinger Bands. Remember, our so-called targets, they're based pretty much on, if we're short, they're going to be based on the support areas. Okay, so now the 1 minute's trying to lean here, and we see the bids getting hit at 1586, 1587, and the 5 period moving average is testing right now. It's leaning through. It's trying to lean through. Okay, but keep in mind that the 5 minute stochastics has yet to cross down. Okay, the stochastics have kissed. It's what we call a kiss, and that's right as it's about to cross down. But we noticed some algo sweeps that came right in, spiked it back up to the 1593, 1592 area. But our 1 minute stochastics is still down. What's really going to take the stock down is when the 5 minute stochastics finally give it up and slip back down. Now, we see the bids are starting to firm up. Like I said, look at the bids. The algo sweeps are coming in. All right, but we already know that 16 is a very tough resistance area. And so if it gets near that 16 area, okay, we still have buying power, and we'll look to add some more shares. And that's exactly what we're doing. We're adding into the pops. So we added another 4,000 shares to bring our average back up. Well, our average is still around 1593. Okay, but once again, when we have the bigger sizes, we want to make sure that we're taking some off the table. So we put in more limit orders here. Now the 1 minute stochastics is still down. And the fact that they couldn't get back up through the 15 minute 5 and they reject back down, okay, that's what's going to help us get that 1 minute to finally mini inverse up through a lower Bollinger Band, and for the 5 minute to finally cross back down. Now look at this. Right here on the 5 minute, we notice that the stochastics, they actually look like they may be trying to cross up. Okay, so this is what we call a make or break, where the stochastics looks like it's going to cross up, or it may have already crossed up, but that 5 period moving average is still holding as a resistance. Now the 1 minute, everything relies on the 1 minute right now. If the 1 minute crosses back up, we could get a spike and a tightening back to the 1626 area, which is 15 minute 5. Naturally, we don't want to sit through something like that with 14,000 shares. So should it do that, should it start to pop, get a 1 minute cross back up, we'll start to scale out smaller stops so that we can add at a higher price level. Okay, so we're working basically within the range here of the 5 minute lower Bollinger Bands, okay, and then the 1 minute upper Bollinger Bands and 5 minute 15 period moving averages. Now look at the bid. Okay, 63,000 shares on the bid at 1593. Now you would expect something like this to basically panic traders into buying, all right, so that the algos can go ahead and proceed with their sweep. However, keep in mind that when we look at the history of that 5 minute chart, we've noticed that they'll go ahead and allow this to pop up towards that 5, maybe even overshoot it, okay, but they have consistently been taking it back down under the 5 minute 5 period moving average. And as far as the 1 minute, it's kissing right here, okay? It's kissing right here. It's nearing that 16 area. And right here, it looks like that 1 minute's going to try to cross up, okay? So what we're going to do is we're actually going to go ahead and put in our cover orders a little higher in the event of a rug pull. So we're gonna trim our targets. Okay, we're gonna trim our targets in the event that this thing gets a rug pull, because the 16 area tested multiple times. Every time it got over right around that 1605 is where it would peak, and they would come in for a rug pull. And when you have something like that, and it's so obvious here, that 16 so obvious, what tends to happen is a lot of traders will go ahead and take that obvious 16 resistance area, and they'll put a stop 1 or 2 ticks above there. And that's exactly what's going on right here. Look at this. So the algos were able to sweep it up, and then you have basically complacent traders that have put in their stop orders right at that 16 or 1601 or 1602, and look at that. They flash, spike it up. They're hitting stop orders. And when you put in a stop limit order, basically, if that price hits, it's going to put in a market order. Okay? So that is free money for the algos. It's free money for the algos and the funds that are able to manipulate that price up temporarily to trigger those stops. All right? So at this point, we're still waiting here, because at 1605, that's pretty much the range of that resistance. So you got stops that are trying to trigger here. Okay, you've got the 5 minute that looks like it's going to try to cross up. You got the 1 minute, it did cross up. Okay, but if it's going to be a true breakout, what's going to happen, guys, is that 16 breaks. This thing should immediately flush all the way up through 1610. Okay, but at this point, it doesn't look like there's that many buyers here, so many buyers here. You still see a lot of selling coming in at 1601. Okay, I'm sure stops were a lot of stops were triggered, but it's not making too much upwards progress. Now, the 5 minute is now the 5 minute 5 is now at 1594. Okay, 5 minute 5 is at 1594. The 1 minute stochastics did coil up, but one thing you keep in mind: moving averages are very flat on that 1 minute. So even though the stochastics cross up, you have to look and see, well, how is the underlying price moving? Is it exploding to the upside? Is that something that would actually get me a little more panic and start to scale down? Or was it a flash pop and then it's feeling resistance again? It's feeling heavy again. Okay? So here we go. We're still battling that 16. Okay, the bids at 16 got taken out. The 1 minute's still trying to coil up here. The 5 minute's still trying to coil up here. And like I said, the last time this thing spiked, it got up to 1505, and then they just completely rug pulled it, which is what got us to jump in and short some more. So now the question is, it's muscle memory time here. Okay. All right. Now look right here. They're hitting stop orders. It comes another algo flush attempt. Comes another algo flush attempt, and at this point, I may be starting to get a little more nervous, okay? But if they get that bid up through that 1605 and they hold it and they're able to tick or break 1610, all right, then that's when I'll start to get a little more nervous and maybe trim down the size. Consider adding more size, more closer to that 15 period moving average. All right, so you always have to be prudent here. All right, we shorted another 1,000 more here, okay, because notice how quickly they rug pulled. They rug pulled right through. Now, the one thing that is not showing here is actually something that I'm watching is the SPY, okay, and the funny thing is, it's at this point where the SPY actually spiked up, so a good chunk of that pop on Petrobras could be a result of the SPY. However, the SPY is grinding at this point. The SPY is grinding higher at this point, and Petrobras is actually down ticking. And that's what we call a sulfate. And at this point right here, the SPY peaks and starts to pull back, And then what happens to Petrobras? Look at the bids. They start evaporating. So so basically Petrobras triggered stop losses up all the way up to 1607, sucked in some buyers. They're watching the SPY or the SPOOs, the futures. Futures are rallying, but even as the futures climb higher, Petrobras starts to sell off again. That's what we call a self-fade. And where's the trapdoor? The 5-minute 5-period moving average, which is at 1594. Watch 1594 here on Petrobras. 1594, it's ticking. Once that goes, that sets up a 5-minute inverse pup breakdown, which is triggered by the 1-minute stochastics that's crossing down. So right here, okay, is where the trapdoor should open up. Look at that 1-minute stochastics. It's now crossed down. And then on PBR, the 5-minute stochastics, it's considering again, It's wavering. This is what we call a make or break. If they spike it back up through 16, 5-minute could mini pup. But they can't do that without the 1-minute stochastics cross back up. So right now, we're in a position of power here. There's a 1-minute cross down. What we really need is that 5-minute to just finally wilt and cross back down. Now look at Petrobras 1592. Oh, you had a 50-something thousand share bidder. He just got wiped out. He got wiped out, and that is starting to scare people. Now remember, when it first came down, 1586 is where Petrobras pretty much bounced off of. And so that's another level that we want to watch. Okay, psychologically, if you stepped in at 1586, let it pop to 1607, and you didn't take money off the table, okay, likely you don't want to go in the red. So anything above 1586, if they take that down, that whole new batch of buyers gets taken out. Now we're throwing some limit orders in here now. Okay, 1587 and 1584 for 7K apiece. And that's because we know 1586 was support last time. So we're going to sit in there and take advantage of this 1-minute stochastics down so that we can go ahead and take money off the table. Okay, we're 1 tick above the prior support area. So we just got filled on that. Now 1585 is testing. 1585 is testing. 1585 just got taken out. Bam, bam. And here comes some panics. And we have just 1,000 shares left. 14,000 shares have already been covered. And look at the 5-minute chart. It's crossing down. And the 1-minute is making a mini inverse pup lean through that 20 band. Now, another thing about Petrobras, it's not a stock that really moves that much, okay, which is why it's important that you know your stocks. If you're only playing 200 shares, well, you're talking about 5 to 10 to 15 cent scalps. Okay, so depending on your broker, he's the only one making money within this range. So your share size has to be relative to the range that you're trading. And notice how it coiled back up to that 1593, 1594 level. Okay, the ranges are small here. You got to always keep that in mind. So that's why you got to play more size if you're going to have any meaningful types of gains. And notice that as soon as we got filled, okay, yeah, it ticked down to 1582, 1581, and then it's coiled right back up again. Okay, so that's why it's important to take your money off the table. And don't look at it just from a surface level and say, man, I could have, the pullback was too small for me to take the profit. Well, that's why we scale into the position. Okay, we scale into the position so that we can get our average price to a more favorable level. And so this is the last 1,000 shares, and the 1-minute stochastics, it's pretty much hit the bottom and it's trying to coil. So now the question is it going to cross back up, or is it going to reject the 5-period moving average on the 5-minute chart and then continue to cross back down? So here comes the 1-minute starting to kiss again, 5 minutes starting to kiss again. And the funny thing about Petrobras is, just when these signals start to form, either to the downside or for a bounce, what happens? The algos come right in and they steal that liquidity, okay? Or the minions come in and then they get flushed. Either way, all right. So the remedy to that is you gotta be able to foresee what's about to happen, and then be able to react right into that. And oftentimes, it's gonna be in the opposite direction of that cross. Okay, they like to head fake with that cross, just like they did right now. Look, in 1 minute, see how it crossed up a little bit? They head faked it up to that 1593, 94 level. All right, and then what are they doing? Then the sellers are coming right back in here again. And once again, 1586 level getting taken out. 1580 is where it coiled last time. So on that initial kiss, they sucked in lungs, and they trapped them, and then that's where they get the liquidity. The big boys get the liquidity to go ahead and sell into. At 1582, that's where it bounced last time, right about here, and they're trying to take it out. Okay, so now at this point, we don't want to miss this opportunity, and we go ahead and we cover 500 out at 1581. As a 1 minute crosses down, a 5 minute crosses back down, and then we place a buy limit at 1578, and we get filled. And that's that. 5 minute inverse pump, 1 minute inverse pump. There's a whole lot of wiggles. We scaled into the shorts, and then we scaled out of the shorts. So on that PBR gapper trade on the short side, it had the 5 minute inverse pump, the 1 minute inverse pump triggered, but they kissed, wiggled, triggered. So the trade was, we got in 15,000 shares short, average 1693, scaled in, and then we covered 1587, 83, 81, 78 for total profits of $1,183. Okay, and then on both sequences, we had a profit of 1,845 during the morning wet climate, scaling in and scaling out in under 45 minutes. And these are stocks that had gapped up on news or earnings. And one last note about Petrobras Gapper, it was a gap up due to some political change, elections in Brazil. Okay? And these type of things, they're not really very material immediately to the company. So I like shorting gaps like that. I also like shorting gaps where a company decides, hey, we're going to split into two companies. All right. Well, if you take one piece of crap and you split it into two smaller pieces of crap, it's still a big piece of crap. Okay. So the excess gaps up, oftentimes, most of the times they're going to gap up and then they're going to sell back down. They may not sell all the way back down, but you're going to get some type of a reversion. And I like to play the reverse, the gap and crap, no pun intended. So that's how we use the rifle charts. We utilize the 5 and the 1 minute rifle charts on both sequences. And they give you the playing field, they give you the bumpers, they give you the direction, okay, the stochastics. That's going to be your engine, the moving averages, Bollinger Bands, but that's going to be your roadmap. And with that alone, in addition to monitoring a lead indicator like the SPY or the SPOOs, that alone is going to give you a very strong advantage, the ability to be able to find entries and exits. All right, so I talked earlier about the iceberg principle. This is what an iceberg looks like. 20%, maybe 20 to 10% is usually what you see above the surface. The other 80 to 90% is what lurks beneath, and that is the foundation of that iceberg. And everything you saw there that's the 20% portion, all right? you have the 1,846 profits in under 30 minutes or 45 minutes. That is all a byproduct of harnessing the proper skill sets, the right piping your efforts into the right areas of growing, of evolution as a trader. Being able to understand the difference between a wet, dry climate, understanding the trade sequences, familiarities with the correlation with the SPY, the actual rhythm and how the particular stocks tend to move normally, which is kind of sucky, and then after a gap on some type of news, be it an earnings report or election-based momentum, knowing the stinky 5s, 250s levels, and obviously managing your pacing yourself and managing scaling in and scaling out with the rifle charts, risk and probability management, and all that goes under the topic, under the category of seasoning. So this is what you can do once you get your skill sets up to par. And that's how you play entries and exits with the rifle charts. Now, for those of you who are still around, Alpha 7 is giving away some free trading courses. So all you have to do is just go to their site, alpha7trading.com, and register. And they'll go ahead and give you a couple more trading lessons and give you an opportunity to take the trading course. If you find this style, this particular style, if you find that it's something that you're interested in, you have the temperance and the prudence and the commitment, then that's something you should consider taking. And that's going to go ahead and wrap it up today. I want to thank everybody for coming out. Mr. Rob, are you there?
Yes, still listening.
All right.
Okay, guys, thank you very much for attending. Jay, that was great. I hope everyone was able to really take some of the lessons to heart here and really learn some of those. So definitely, thanks, Jay. Yeah, definitely take a look at the website, alpha7trading.com, to register for some free trading courses and to just go further into detail of what he explained here. So, and guys, if you have some questions, feel free to email them in to us. I certainly can send them over to Jay, and he'll be more than happy to answer some of those for you.
Okay, absolutely. Thank you so much, Rob, and good trading, everybody. Thank you.
Okay, thanks a lot. Take care. Have a good night, everyone.